Welcome to the 2022 forecast event with Concord Wealth Partners. I am the CEO and founder, Wade Lopez. I have with me the Chief Investment Officer for Concord Asset Management, Mitch York. Mitch, welcome.
Thanks, Wade.
I'm glad to have you here again. You were here last year in the halftime report, so this is your first forecast event. Let's talk about the agenda. When things we're going to be talking about, hearing from Mitch are his views on the economy, financial markets, and what may be ahead for us. And of course, we're going to start with the economy. And Mitch, number one on most everybody's mind is COVID and the impact it had on the economy last year. So let's start off with that.
Sure, Wade, there's no doubt that the key to having sustained economic growth is to really get a handle on the virus. And no better way to do that is through vaccinations. And we've seen that the developed world has done a really good job vaccinating its population. As you see in the graphic in front of us, that 73% of the U.S. adult population have received at least one dose of a COVID vaccine, and the majority have received 2 doses. And of course, we know now a lot of people are receiving their booster shot. And that's really key because this gives people confidence to go out and live their lives as normal, like they did pre-pandemic. And I think nowhere is this more evident than in the entertainment and leisure sector. This was the sector of the economy hardest hit when COVID shut down the economy and really slowed things down. But what we've seen through vaccinations and people going out and living their lives, we've seen a big recovery, and people are back going to movies, they're traveling, going on cruises, and this has had a profound impact on economic growth in this sector and even more broadly.
Well, let's go back to, you mentioned the economy. How'd they end up for us last year?
Sure. So last year was a really robust economy. If you consider GDP growth, in 3 of the 4 quarters, we had over 6% GDP growth, which is really fantastic. It was only in the 3rd quarter where there was a dip last year where GDP grew a little over 2%. And as you may recall, that was because of the Delta variant, which spread quickly and had really harmful impact. And so there's a pullback in economic activity, which we would expect.
And what did that mean as far as employment for last year?
Right. Employment made great gains last year. And so the unemployment rate ended the year at 3.9%. And we saw in most all demographic groups, the unemployment rate dropped significantly as people got back to their daily lives, firms started hiring again. And we saw that it was a broad recovery in employment and really driving down that unemployment rate. Right. So currently in the U.S., there's about 6.3 million people unemployed. And we've also see that right now there's a little over 3 million people that aren't working due to COVID. And this may be people that have been displaced from their jobs because the factory may have shut down, the restaurant has shut down. These jobs simply don't exist anymore. And there's also a little over 1 million citizens that cannot seek work simply because of maybe they have health conditions and they're unable to go back out there, or they're unable to find child care, so they really can't even look for a job, and they're out of the labor force.
Yeah, and last year we talked about how conditions for employers, the space got so competitive, right? So what's that meant this year?
Right. So this year we've seen a rise in wages as employers are competing for labor, and also the labor force participation rate declined. There's not as many people out there willing to work. We call this the Great Resignation. There's a cultural change that happened last year where a lot of people simply decided to retire early or to take a break and really are not interested in seeking work at this time. So as the economy grew and the demand for labor increased, and the supply of labor, though, decreased, that put an upward pressure on wages in the U.S.
And you mentioned supplies, so let's talk about supplies. Like a lot of us, your Christmas present didn't show up that I got for you yet. So we have supply issues. In all seriousness, what's that mean to us right now? Where are we at? We got builders that can't get their roof trusses. They don't have the gypsum issues. So where are we at right now with supplies?
Well, all of us are familiar with the supply chain issue. It's on the news all the time. We've seen the reports about cargo ships docked off the coast of Southern California. And really, the supply chain issue started. It was a manufacturing issue. A lot of factories simply globally shut down, especially in China. A lot of factories shut down, really choking the supply chain. The products weren't being produced. However, what we saw last year was a really robust recovery in manufacturing. As a matter of fact, the data now shows that manufacturing output, as measured by the PMI, you see in the chart in front of us, that manufacturing output has now reached pre-pandemic levels. So the supply chain issues that we're dealing with right now, it's not really a function of manufacturing output, it's a function of getting those goods to the final consumer, and that's the struggle that's going on. Now, the good news is that recent economic data, there's evidence that we've hit an inflection point and things are starting to turn. So although this supply chain issue is probably going to impact us for the remainder of this year, it's certainly going to alleviate as time goes on.
But what's that mean for us from a cost perspective?
Well, we all know that there's inflation, right? Every time we go fill up our car with gas, we go to the grocery store and put food on our table, those bills have gone up. That's simply a fact. And right now we're facing an inflation rate that we haven't seen in over 4 decades. And that, again, it's a function of a robust economy, that people have more money now than they did before COVID simply because they weren't spending money. They save more. People are earning more money, as we saw that upward wage inflation. We've also had a lot of stimulus provided by the federal government and also by the Federal Reserve, who've increased the money supply and kept interest rates really low. So it's a function of both supply and demand. There's strong demand from us consumers, all that pent-up demand, and we have the ability to purchase goods and services. And also, there's been that choking of, in the supply chain of getting these products to market. So that's had a really profound impact on prices. Now, as you see in the chart in front of us, there's 2 lines. There's a blue line and a red line. Inflation has really hit hard in the areas of food and energy. And so food and energy have had a disproportionate price increase than other goods and services. And that's a problem because we know that for lower income earners, they spend a greater percentage of their income on food and energy than higher income earners. And so this is really problematic right now.
Yeah, and you talked about, wages are up, costs are up. So where's the consumer's head right now?
Well, I think it's not surprising that consumer sentiment is at a pretty low point right now. And if you look at year over year, the consumer isn't feeling as confident as they used to. And a lot of this has to do, or probably most of it has to do with higher prices. Inflation is a really strong economic headwind. And it's not just a water cooler issue at business and companies like mine. It's a kitchen table issue that people are talking about inside their homes. So if you look at broadly consumer sentiment, it is down. This consumer sentiment index is down over 12% year over year. However, I will say there is light at the end of the tunnel, and that consumer sentiment in the last month or so has ticked back up, and I think that it probably will continue this year for a couple reasons. One is that we see that COVID is not having quite the impact on our lives that it used to. Economic impact has not really fallen off as we've seen the surge from the Omicron variant. So people are feeling a little better about that and the economic prospects coming up in the next several months.
So the next phase leading into would be, what's the Fed think about all this?
Sure. As I mentioned before, the Fed provided a lot of stimulus to the economy that led to inflation. And so the Fed has made a policy change. They've done a 180 where they realize now that they need to take action to cool off the economy and slow down that pace of inflation. And Wade, they have to thread the needle just right, because if they act too slowly, they risk inflation being higher than what they want and more sustained for a longer period of time. However, if they're too aggressive and if they overreach on this, they risk choking off economic growth and could even lead to a recession. So the Fed has to thread that needle just right so they can tamp down inflation without really choking off economic growth.
So what did the Fed do last year?
Sure, yeah. If we take a step back and look what the Fed did when COVID first hit the economy and the economy was shut down, the Fed realized they needed to provide a lot of stimulus. And they did that through a process called quantitative easing. Quantitative easing is when the Federal Reserve will go to financial institutions, you can think these big banks, and they will buy bonds from the bank and then give them cash in replacement. So it provides a lot of cash to the banking system. And then what do banks do when they have all that cash? Well, they loan it out. And when they loan it out to individuals and to businesses spend that money, and it starts a process of really causing a lot of economic growth. So the Fed in the spring of 2020, they started by purchasing over $700 billion worth of bonds from these financial institutions. And then when that was complete, they announced every single month they were going to start buying over 120 billion of bonds from these financial institutions, and that finally ended just recently. So the end result of that was an increase in the money supply. And if you see on the graphic ahead of you, this is what we call M2 money supply. This is the cash in your pocket. This is your balance in your checking and savings accounts, CDs, and the different deposits you have at the bank. And the Federal Reserve, through their actions, really helped money supply grow an astounding almost $7 trillion during the last 2 years, Wade, which is a tremendous amount of growth in money supply. And that money's out there, a lot of liquidity, really led to a lot of inflation and where we are right now with that headwind.
Cool. So that's where we were last year. The next thing we want to talk about is the financial markets, and the financial markets of where we are, where we ended up the year. Let's talk about earnings, and with earnings, let's talk about the S&P.
Well, I don't think there's any surprise that with such robust economic growth and all the liquidity the Fed provided and the stimulus from the federal government, that corporations made a lot of money last year. Profits grew for S&P 500 companies 45% year over year. They made a lot of money. Now, so you would expect stocks to react positively to that, and they did, but in general, the market returns for all, if you think of all the investment marketplace, were mixed last year. For example, in the S&P 500, it earned over 28%, almost 29% for the year, which is an outstanding return. However, if you think about long-term bonds, long-term treasury bonds actually lost over 4.5% last year. Now, the NASDAQ index went up over 22%. However, if you think about emerging market stocks, they actually declined over 2%. And then there is the Dow Jones 30. Those stocks, they returned over 20% last year, but the broad bond market lost 1.5%. And then let's talk about small cap stocks. The Russell 2000 index, a measure of the performance of small cap stocks, it earned 14.8%, about half of what large cap stocks earned, although still a really nice return. But investment grade corporate bonds, on the other hand, lost 1.5%. And then finally, Wade, the MSCI EAFE index, that represents stocks in foreign developed markets. They gained 11.8%, a good return, but significantly less than what most U.S. stocks earned.
Well, let's kind of go back and reflect on the earnings of the S&P 500, because wasn't really fair, was it, to kind of just, we talk about the S&P 500 earnings, but I think we need to point out a few things.
Sure. So the S&P 500 index is a market cap weighted index. And what that means is the larger the company's valuation, the larger its impact on that index's performance. And in the S&P 500 index, there were 5 stocks actually that accounted for 1/3 of the performance of that index. These are the big mega cap stocks. Wade, there is actually multiple companies out there now that have a valuation over $1 trillion. Apple actually recently hit $3 trillion in market capitalization before it pulled back. So there's no surprise that these companies dominate market returns. And as you can see, it was Tesla, Nvidia, Google, Microsoft, and Apple. These stocks accounted for over 1/3 of that index's return. The other 2 major mega cap companies, Facebook and Amazon, they underperformed that index by and large. And then you can see in that circle on the graphic, that's all those other about 500 companies all kind of lumped in together, the impact that they had on that performance.
Well, a lot of earnings. Are there opportunities out there?
Well, I think opportunity really depends on how you feel about the stock market's valuation. Is the stock market valued high, or is it low, or is it just right? Well, recently we've seen a sell-off in the market. A lot of people are concerned that the stock market is overpriced, so we're seeing a lot of selling. However, let's talk about this Shiller-Cape price-to-earnings ratio on the S&P 500 index. We talked about this at the mid-year report. It's talked about a lot in the marketplace. What this price-to-earnings ratio does, it takes the last 10 years of earnings on S&P 500 companies, and then it adjusts them for inflation, and then compares that to its current price. So you get a smoothing kind of historical context to how the stock market is currently being valued. And right now, it certainly is at a high point, much higher than its average over the last 50 years. However, this shouldn't be looked at in a vacuum, in isolation. We really need to talk about this in context to other investment alternatives. And most commonly, it's compared to the yield on the 10-year U.S. Treasury bond. Right now, that's a little bit under 1.8%. So when you consider where the stock market is valued right now versus the yield on the 10-year Treasury bond, most people would say it's probably fairly valued. And even Shiller himself recently said that when you consider in this context, it's hard to say stocks are highly overvalued. But Wade, we're going to find out. The market's going to tell us what they really think about that this year.
Well, domestically, yes, but let's talk about globally. What are some things we need to be concerned with?
Well, I think front and center what we need to think about internationally is China. The U.S. economy and the Chinese economy they're intertwined. There's no doubt about that. We have a massive trade deficit with China. We're actually their major trade partner. And we saw how important China's economy and production is when we saw these supply chain issues over the last couple of years. So what happens in China affects the world, and it certainly affects the U.S. economy. And there's a lot going on in China right now. Last year, the economy in China grew a little less than 9%. Sounds like robust growth. However, that is actually lower than what it's been growing by over the last several years. This year, the economy in China is expected to grow by 3.8%. That is actually less than the expected economic growth in the U.S. So it's kind of a new environment in China. And actually, Wade, what was really surprising is that the Central Bank of China, that they were so concerned about economic growth, a couple weeks ago, they actually cut interest rates, which is really surprising to a lot of people because the rest of the world is raising interest rates or thinking about it to slow down the rate of inflation. In China, they're worried about the growth of their economy. That's what's front and center to them. So their central bank actually cut interest rates. But that's not all that's going on in China. We've seen that the heavy hand of the Chinese Communist Party, they're coming down with a lot of regulation in the economy, especially when it comes to a lot of online and technology services. We've seen that the real estate market is struggling right now. That is by and large the biggest part of the Chinese economy, and one of their largest real estate companies recently almost defaulted on their debt, which caused a lot of problems. And there's other things, so there's a struggle going on in China. We really need to keep our eye on that this year.
We touched on, the Chinese reducing interest rates. Let's come back here domestically and talk about bonds and yields here in the U.S.
Sure. So there's two parts to this story. First, if you look at where yields are right now in the U.S., like I said, the 10-year Treasury is a little under 1.8%. That is actually low versus the average yield over the last several years. Just a few years ago, the 10-year Treasury bond was yielding over 3% part of the year. So relative to that, interest rates are still very low and yields on Treasury bonds are still low. But that's not the real story. It has to do with the trajectory. Over the last year, we've seen interest rates rise, bond yields increase, and so that is what the trajectory is. And we think throughout 2022 and probably beyond, we're going to see that trajectory continue and bond yields continue to rise as the Federal Reserve it raises interest rates and inflation causes yields to rise as well.
So what are we going to do for investors? They need income. What are we looking for here?
Well, here this is a struggle everyone's been dealing with for quite a while, that even in this rising interest rate environment, rates are still really low. And so Treasury bonds really don't provide much of a yield. So most people look at different types of investments, such as preferred stocks, which pay pretty high dividends. And you have the real estate market, which usually spins off good yields. There's also high yield bonds. These are the junk bonds that pay significantly higher rates of interest than government bonds. And then there's these things called bank loan. Actually, you can participate as an investment in banks loaning directly to companies. And those usually pay better than government bond rates of interest. And then lastly, there's lots of different types of alternative investments, which also usually pay nice rates of interest. Now, however, I would have to say this. There's no free lunch, Wade. With higher yields, if that's what you're chasing, you're also going to be assuming more risk. That really can't be avoided.
So with that, we talked about consumer sentiment a little while ago. Let's talk about investor sentiment now.
Right. Well, there's really two types of investor sentiment. There's investor sentiment among investment professionals, institutional investors, and there's the investment sentiment among individual investors. So there's something called the TIM Market Sentiment Survey, and this is a survey of the professional investors, and they just ask people to basically score that they're bullish or bearish sentiment. If they're extremely bullish, they may score at 100. If they're incredibly bearish, it may be 0. Right now, the average score is 45.3. So slightly bearish, but almost down the middle. If you look at the AAII Investor Sentiment Survey, this is the Association of American Independent Investors, it shows actually kind of a similar result. It's mixed as well, because about 30% of individual investors are now bearish, and about 38% are bullish, and around 32% are neutral. So there's also a mixed signal there. And I don't think this is a surprise, because Wade, think about it. Everything has changed this year, going into this year, from the last 2 years. The fiscal stimulus that the government provided, that's in the rearview mirror. Right. The Federal Reserve has done a 180 in policy. No longer are they going to be providing all this liquidity to the marketplace. Instead, they're going to be raising rates. They're even talking about helping contract the growth of money supply through a process called quantitative tightening. Right. And so it's a totally different environment. So I don't think there's much of a wonder why investors, are kind of have mixed signals right there going into 2022.
Thank you, Mitch. That's great information. We're at the point in our agenda, though, where we're going to where we may be going. But before we do that, I'd like to introduce the newest member of our Rockville, Maryland office, and that's Becky Blevins. Becky, welcome to Concord Wealth Partners and our forecast event for 2022.
Thank you for having me. I'm very excited to be a part of this forecast and also to help with the clients in the Rockville office.
Awesome. What we'd like for you to do is touch on something we call ESG. We talked about it in our halftime report of 2021, but I'd like for you to expand on where we are now going forward in 2022.
Thank you. Impact is becoming a very powerful tool in investing, although the idea of putting capital to work to encourage change isn't new. It has evolved over time, from screening for specific negative characteristics to a set of wide-ranging strategies developed to deliver results. People use a variety of terms to describe it: environmental, social, and governance investing, ESG, responsible investing, sustainable investing, socially responsible investing, known as SRI, and impact investing. ESG is an unconstrained investment universe, while SRI is a focused investment universe and impact investing is a very focused investment universe. So what's really the difference? People want ESG integration, want to do more to manage the risk in their portfolio, while SRI, they want to support companies who do their business with ESG practices in mind. Impact investing clients, they want to invest in companies that will change the world. Most people lump all the impact investing under the term ESG. In the long run, all types of impact investing is investing with the intention to generate positive and measurable social and environmental impact alongside a financial return. In this slide, you can see that interest in impact investing has grown amongst institutional and investment professionals. So growth is not driven only by investment objectives. Asset owners and asset managers are also being scrutinized by regulators and investors who want impactful and sustainable investments. The Natixis 2021 ESG Investor Insight Report shared the reasons that institutions and individuals gave for pursuing impact investing. You can see them here on the screen. Investors and consumers are demanding sustainability. In 2020, 92% of S&P 500 companies and 70% of Russell 1000 companies published sustainability reports. It's important to note there is no standard or rule to be considered an ESG or any other type of impact investment, but many large companies are leaning in that direction, whether they call themselves ESG or not. Of course, no matter what investment strategy you adopt, the performance of the economy will have an impact on your investments.
Thank you, Becky. It's great information. Becky's kind of outlined what ESG is. What is ESG for us in our portfolios within CAM?
Wade, there's several ESG portfolios available to our clients where we apply the ESG theme broadly over the portfolio and also include specific investments in water and clean energy. But in addition, we have custom solutions available where we can actually take a client's personal preferences, value proposition, and use that to construct a personalized portfolio where we can exclude certain companies and industries that may violate their personal values and preferences.
Awesome. So let's move on to economic growth. What do you see down the road for investors for economic growth in 2022?
Well, let's talk about what CEOs see as far as economic growth goes. There's a survey called the Business Roundtable Survey, and they survey CEOs across the country in many different industries, and they actually expect economic growth to be 3.9% in 2022. And that actually, in a historical context, is pretty robust. So the chart that we all are looking at, there's a red bar going across. That's 3.9% economic growth. All those blue bars on the chart, that represents quarter by quarter GDP growth. And you can see the expectations is for above average and really robust economic growth for 2022. Not the economic growth we've seen a lot the last 2 years because of all that stimulus, but still 3.9% is a really optimistic outlook on the economic expansion.
Well, let's talk about what are they really seeing as far as optimism. Let's kind of point those out.
Right. In the same survey, they mentioned a few items, and one is their plans are to hire more employees. If CEOs, if their companies are planning on hiring more people, obviously they feel pretty confident about business. Also, they're planning on increasing their investments into property, plant, and equipment, the infrastructure of these companies to expand their business. If they weren't optimistic about the economy, they certainly wouldn't be doing that. And there's also, they're confident in sales growth. The survey showed that year over year that they have their optimism level has increased by 9 points. And then I'd say another item would be the Infrastructure Act and Jobs Act that was passed last year by Congress. As that money, that investment hits the economy over the next number of quarters, that certainly is going to help economic growth in the U.S. And I think the business leaders recognize that as well, and that's one of their keys to optimism too.
So CEO optimism, let's talk a little bit about their pessimism for 2022.
Right. Well, business leaders, CEOs, they always have things that keep them up at night, things that worry them. And I think one of the things front and center certainly is COVID. Although it looks like we have more of a handle on COVID and its impact on the economy and our lives is certainly diminishing. However, we don't know what's around the corner with this. And so there's always that uncertainty that a new variant, something can happen which could cause economic shutdown, turmoil. That certainly worries business leaders out there. And then there's also labor costs. As we've discussed, there's been wage inflation. And not just wage inflation, there has been a decreased supply of labor out there. Right. Companies are having a hard time finding workers. You may see this at stores and restaurants. They're shortening their hours that they're opening and kind of decreasing their services simply because they don't have the labor available to function as normal. And then the supply chain issues. Although we do see light at the end of the tunnel for that, it is going to persist throughout this year, hopefully diminishing, but they still face these struggles. And then there's also this issue of taxes. So there certainly is an appetite in Washington for Congress to raise corporate taxes. And that is an uncertainty that's out there. It's hard for business leaders really to plan for that uncertainty, but it's certainly on their mind. And then lastly, I would say it's rising interest rates. Rising interest rates not only increase the cost of borrowing for companies, it also increases the cost of borrowing for their clients, for companies and individuals. And when the cost of borrowing goes up for families and for corporations, they tend to borrow less and spend less. And that certainly is a threat to economic growth, and I'm sure they're worried about that too.
Well, let's move abroad or overseas or internationally and tell me what some of those worries might be for 2022.
Right. I think a lot of these are what we call these black swan events. These are events that may not be highly probable of occurring, but they can have really big impacts. And the one I think about a lot is cyber attacks and the cybersecurity issue. And we've seen in the last couple of years some isolated incidents of cyber attacks on companies in the U.S. But what we haven't seen is a really broad cyber attack event that has shut down major portions of our economy. And if that were to happen, there would certainly be a big impact on the economy and the stock market as well. And then there's also this issue about what we call global technology decoupling, especially between the U.S. and China. There's always this issue about, is China still in our technology? And, well, what about the technology from China that is already in the U.S., cell phone technology, things like that? And there's been this talk and this issue about really decoupling this technological tie between the U.S. and China. And then also with China and with Russia as well as this geopolitical risk. Certainly what's in the news right now is Russia and their aggression towards the Ukraine. Are they going to actually invade the Ukraine? What's going to happen there? That would be an event that would cause a lot of geopolitical turmoil. Certainly the stock markets globally would not appreciate that. And then there's always hanging out there is China and their aggression, their desire to reunify with Taiwan. That would have major economic consequences and stock market implications because, Wade, Taiwan is by far the largest producer of microchips and semiconductors globally, and the thought of China taking over that economy and these companies, it would certainly be concerning to everybody.
Mitch, that's great information, and we've gone over a lot of stuff, where we've been, where we are, and where we're going. But let's measure that down, and what do you really want to hammer home? What are your final thoughts that you'd like to get across to our investors?
What I want to leave with everyone is that 2022 is about adjusting to a new reality. And all this stimulus that we've had last year and in 2020, that's all in the rearview mirror. The fiscal stimulus that provided by the government, that is gone. And the stimulus from the Federal Reserve, as we just discussed, they've done a 180 in policy, that's also in the rearview mirror. And where we've had this extremely low interest rate environment, well, that's changing too. The Federal Reserve has committed to raising rates at least 3 times this year. And that's a totally new environment to what we're used to. So all that liquidity that provided all this economic growth, that's behind us. And so this year, the market's facing something very different, and I think we need to adjust our portfolios appropriately. The key to 2022, in my opinion, is going to be diversification, diversification, diversification. And let's talk about that specifically in 2 distinct areas. First is in stocks. So I believe the key this year is to be internationally diversified. Owning foreign stock, I think, is going to be pivotal for a couple reasons. One, foreign central banks are not nearly as aggressive as a U.S. central bank. That's what we're looking at for this coming year. At the same time, foreign stocks are at historical discounts to U.S. stocks. Wade, foreign developed market stocks are actually trading at a 30% discount in valuation to the S&P 500. Emerging market stocks are actually trading at a 42% discount to the S&P 500. These are all historically wide discounts. And at the same time, where foreign central banks are concerned about inflation and looking at maybe raising rates a little bit, they're not nearly as aggressive as our central bank. Therefore, I think it's pivotal to have foreign stock diversification in your portfolio. At Concord Asset Management, the average investor has about a little over 30% of their equity investments in foreign stocks. So they're well diversified now in this area. And then secondly is bonds. We're entering a new environment for bonds as well. As we mentioned before, the trajectory is upward in interest rates. We don't see that being alleviated anytime soon. And so we know that bonds don't perform well in a rising interest rate environment. So when it comes to income investments, we really need to think about not only traditional bonds, but also these income investments that are floating rate and also alternatives. So I think the key to the bond portion of a portfolio is to not only own some of these traditional government type bonds, they're still necessary because they provide downside protection in a portfolio. It allows us to take on that equity risk, but also be considering floating rate securities and alternative securities that generate yield as well. And these actually function much better in a rising interest rate environment. Actually, they perform sometimes well in a rising interest rate environment. And combined, I think that provides a lot of good diversification entering in a year of such uncertainty where everything has changed and we have this new reality for the markets.
Excellent. I'm hearing the word diversification, but I want to add one other thing, and that is for our investors out there, what's changed in your life? What's happened that maybe we're not aware of, because that's a key component to the risk we take inside that portfolio. For example, maybe you didn't go back to work or your job hasn't come back the way you wanted to, so you've considered early retirement, a new grandchild, or even a loved one has had to move in and considered dependency upon you to add extra stress on your portfolio for income purposes. Whatever it is, please let us know as soon as possible and talk to your advisor, because that's also something that everybody wants to know at CAM as well when we have those discussions and determine what the portfolio risk needs to be based on those changes that are affecting you today. So with that, Mitch, I'd like to say thank you very much.
Thank you, Wade.
Great information. Look forward to working with you in the halftime report, which will be your second one for 2022.
All right.
All right. Thank you very much. And thank everybody out there for our clients. We appreciate all the things you do for us, and the fact that you're allowing us to be a part of your life means so much to us. Thank you very much.